So
Yeah.
welcome everybody to Friday Night Live with Accountants. Anyway, I'd like to welcome Dr. Reginald Lee. He's a professor of management, is it?
Yep.
Is it management? Management at Xavier University, which is located in Cincinnati. Is that correct?
That's correct.
Okay. And he has a PhD in mechanical engineering, but has studied in the fields of accounting and management. And he wrote several books. The two most recent, which are the ones that we're going to be talking about today, one is called Lies, Damn Lies, and Cost Accounting. Great title, by the way.
Thank you.
And that was written maybe like 5 or 6 years ago, right? Something like that.
Probably 3 or 4.
Three or four. Okay, so it's very recent. And then the next one, which is the one I have here in front of me, which I'm just finished reading, also in preparation for this, called Strategic Cost Transformation, which is a good part two for Damn Lies, and Cost Accounting. And the basic premise of the two books is that accounting standards may lead us to make the wrong decisions because they only measure one dimension of the business, okay, which Dr. Lee calls it the accounting domain, and we'll discuss that. But as accountants and business consultants, we also need to look beyond the standard accounting measures, especially when it comes to cost accounting, and we'll discuss the whole perils of cost accounting, tracking costs by item, by customer, by project, by department, all that stuff. And there's an opportunity for us to consult with our clients in other areas, which is not just the accounting domain, which is called the operating cash domain. Is that what it is?
Yeah. Operations and cash. You've got two
operations and cash name. I'm working all this from memory. So,
you're fine.
So we'll discuss that. So Dr. Lee, first let me ask you, why did you write Lies, Damn Lies, and Cost Accounting? So we'll start with that. Welcome to the show.
It's a really interesting story, and thank you for having me on the show. It's kind of fun, especially on a Friday night. So Lies, Damn Lies, and Cost Accounting was actually requested by the guy who created the Society of Cost Management. And so his name was Michael. And unfortunately, he's no longer with us. But Michael had gone back and read one of my early books, Explicit Cost Dynamics. And he said, have you updated your ideas in a while? And I said, no, not really. And he said, we need to get you out there. We need to get more of this because I think that cost managing people need to see more of this. So he worked on me for probably a year or more and got the publishers and kind of did an end around and said, hey, will you guys give this guy a contract to write this book? And so after the conversation, then we decided, let's go for it. And so that's how Lies, Damn Lies came about. So it was really almost like a prequel to my first two books. And it was to try to explain why is it that we need to look at things a little bit differently. And so it kind of laid out some of the fallacies of cost accounting as it relates to managing the business and understanding cash. So it wasn't necessarily a knock on cost accounting as much as it was a description of the limitations of when and how to use it.
Okay, and the central theme of the book, actually, there's multiple central themes. This book is like 145 pages and it's jam-packed with stuff. But central theme is there are some things that we call measurements that are not really measurements and they're really metrics. And there's a distinct difference between something we can measure and something we arbitrarily measure using our own sort of biases and methods and stuff like that. So can you explain the difference between measurements and metrics within the context of accounting?
Yeah. So the example I often use when I'm giving a speech is this. So back when we had landlines, and some folks still had landlines, and we paid $25, and we have access to phone service for a month, let's say, right? Local phone service. So we can call as many local people as we want in that month, right? But then for a long distance call, let's say it costs us 10 cents a minute. So we know that a 10-minute long distance call will cost us $1, but then I ask the question, what's a 10-minute local call cost us? And so when we take a look at trying to figure out that local call, there's no relationship between what we bought, which is access, and how we use it, which is making phone calls. And so to try to figure out that cost, we have to create a relationship between two things. And so when we create that relationship, there are really an infinite number of ways to create that relationship. So what I do, the way I distinguish the two is metrics are something that I can measure. So when I measure money leaving an organization, such as that dollar for the long distance call, then that's the measure, right? However, when I look at metrics, a metric in my mind is something that we're trying to figure out. And so because we're trying to figure out the cost, then it's subjected to arbitrary math relationships and subjectivity. For example, when I try to figure out the cost of the call, what do I include? Well, some people may suggest that you include, let's say, 24 hours in a day to come up with a per minute rate, for example. Well, someone else may say, well, but you're not making calls for the whole 24 hours. Maybe you're just making them for 16 hours or 8 hours. So there's subjectivity that goes into it. So if I got to figure it out, there's a calculation that's involved, and that calculation itself is going to create a value on the back end that's generally a metric versus something that's measured. For example, if I've got, if I'm measuring length, and this is all, this is my engineering background. Let's forget about all the stuff that Einstein talked about, right? For the most part, we start thinking about measuring time, we start thinking about measuring distance, then those things are fairly precise. I can get a ruler, and within the accuracy of the device I'm using, I know that something's 9 inches or not, right? But if I'm calculating it, then it's subjected to the calculation approach that I create. And so because of that, there's less precision associated with what it is it's trying to represent.
All right, so let's throw like a sort of a small business example out there, right? So let's say, for example, I'm running an accounting firm, and I have 3 accountants on staff, or three staff members, right? So if I could figure out the profit per accountant or per employee by simply just dividing all the numbers by 3, or I could do a proportionate, right? Maybe you doing it based on their salary. Or I could take some other piece of measurement, like figure out how many hours each person works and divide it by that. Or I could take some sort of other arbitrary numbers, like, who sells what, and maybe divide it by that. So the reality is that when it comes to measuring profits by department, by cost center, by project, the allocation method is something that we pretty much choose, right? Like you pull it out of a hat, you do it, and if you apply multiple, you will get multiple results from each one. Therefore, it may lead you to believe that you can make materially different decisions based on which method you use. So because it is our arbitrary choice to what methodology we use, that is a metric, not a measurement. Correct?
That's part of it, yeah. So let's come up with a practical example, right? So you got your accounting firm, and let's say that you want to determine the cost of providing a particular service to a client, right? So when you look at the work that the accountants do, the amount of time that they spent, the work that they created, the deliverables and such, all of that is depending on how you get it, right? But the time that they actually spent doing the work, whether they're reporting it on a timesheet or not. I know the timesheets are a big issue, but if we take a look at the abstraction of it, the amount of time that they spent doing the work is not questioned. That's something that's measured, right? But then when we interpret the value of their time, that's where the subjectivity comes in, right? So if someone says, well, let's take a look at, like you said, the different allocation approaches, or do we consider an 8-hour day, or do we consider a 9-hour day, depending on billable hours? There are a lot of decisions that go into it. So because I've got so many subjective values that go into this calculation, I'm going to get a lot of different numbers on the back end, even though they're all representing the same one situation. And that is, they created the return, they did an audit. That is not disputable. But how we come up with the numbers on the back end to describe what happens is disputable.
Okay, so generally speaking, in accounting, we take investments into inventory. Mm-hmm. We take all the expenses in terms of, like, let's say, factory costs. I do a lot of consulting with QuickBooks users, small manufacturers, and we run into this situation all the time where I need to take the rent and allocate it to each unit of production, and I need to take labor and allocate it to each unit of production. And I've experimented with just making up methodologies. Like I say, look, the proper way to do it is to do this, this, and that. And it always passes muster. Like, I mean, obviously anything I can say, people say, okay, let's do that method. And over the years, I've become more and more cynical about, whether I'm doing a disservice to my customers. The issue is, this is what they usually call me for. They say, Hector, we don't know our costs well. We don't know what our cost per unit is well. And usually they don't say the second step, but the second step, which is hidden there, is so we can figure out how to price it correctly. And that's usually the hidden message, or the hidden meaning behind them trying to figure out how much the per unit, per project, whatever that allocation they're trying to do. So if we don't understand what they're trying to do ultimately is figure out how to price their product better, we're going to do a big disservice using any arbitrary method to figure out what the cost per product is. But even with that, I have challenges, because I don't know what the alternative is, which we're hoping that this discussion sheds some light on what the alternative is. I don't know what is the alternative to telling my client, no, I can't take the unit of measure of time or employee or payroll and allocate it to the cost, or I can't take the overhead, like the utilities and the facilities cost, and throw it into the unit per cost. So what I'm asking you is, what is the alternative when this is the request that our customers have? What is the service that we should be doing instead?
Sure. So let's provide a little bit of context before we go there, because I think context is going to be really important. The way these tools came about was when I was in graduate school. So you mentioned I've got a PhD in engineering, so I hope no one's holding that against me. One of the things I want to be able to do is explain the effects of improvements that we would make, the financial effects, not only the business effects, but the financial effects, right? And so having been trained in some of Goldrat's tools, and I focused on cash. And what I realized was that when I looked at accounting-based numbers, they didn't represent cash. For example, let's take a laborer, right, who makes $30 per hour. If I make them more efficient, they can create more output, let's say, then I've got more units that can absorb that $30, right? So the suggestion is that the cost per unit goes down. However, no less money is being spent. I'm still spending $30. So even though I can suggest that there's a cost reduction, there's no change in cash from a cash out perspective. And so I started wondering, well, why is this the case? And so to fast forward, what strategic cost transformation does is it simplifies what's happening there by breaking the business down into two domains. So if you look at the dynamics of cash, the dynamics of cash are pretty simple, right? I start the day with a certain amount of money. I spend money throughout the day. Maybe I make money through the day. And at the end of the day, I can determine, based on how much I started with, how much I spent, and how much I gained, how much I have at the end of the day, right? It's pretty straightforward computation. For example, I start the day with $10, I spend $5, but I make another 10, then at the end of the day, I'm going to have $15, right? But so if I model cash that way, and if I model the organization that way, then the question becomes, so what affects cash in and cash out? And so that's where the operations and cash domain comes in. So if you take a look at organizations, they really do four things. They buy things, they consume it, they create output, and some of that output they sell. So that's the operations of the company in a nutshell, four basic steps. And so what it is that I buy affects the rate of money going out. What it is that I sell and receive affects the rate of money coming in. And so the thought there is that if you want to focus on cash, you can figure out what's happening from your cash from a business perspective without calculating the accounting numbers. So when you talk about things such as calculating per unit cost, and then you want to add, let's say, a margin to come up with your costs. I know Ron Baker's probably beating us up, and Rhonda Lynn's probably beating us up as well right now. But let's say that's the way people do it, right? Well, a lot of people do it, unfortunately. Then in that context, you got to ask the question, well, does that represent cash? And the answer is it doesn't represent cash. And so are your clients asking you that information, assuming that profit reflects cash? If they are, then we have to go back to that fundamental assumption that profit is equal to cash, and it's not. Because if you think about accruals, which you mentioned earlier, for instance, I can sell you, let's say this Apple Pencil right here, right? I can sell this to you today for $100 and say, hey, you know what? Why don't you just pay me in July? And let's say that I spent the money to buy it, or I'm Apple and I made it back in, let's say, April. And so I spent the money in April to get it. I'm asking you to pay me in July, yet I can calculate a profit in this month. And that violates how cash flows. And so with that basic concept, we've got a violation with cash. We've got a disconnect with cash. And then when you ask things such as, what's this pencil cost? Well, if I'm Apple, and let's say I calculate the cost to be $20, that's, to your point, if I use one technique, it could be $20. If I use another technique, it could be $28. If I use a third technique, it could be $17. So the question then becomes, if I use different techniques, I'm going to come up with different costs. And if I come up with different costs that are based on subjective relationships and assumptions, then what value does that cost have to you in terms of whether you're making money or not? And so one of the things that I propose in my work is that when you get down to making decisions, managerial decisions using that information, you're going to put yourself in a position where you're not going to understand, you're divorcing yourself from what's happening from a cash and operations perspective. Because to get to that cost, I lose a significant amount of information about what happens in operations and cash. For example, if I tell you this pencil cost Apple $20 to make, what do you know about Apple as a result of that? You don't know how many people were involved. You don't know what the people made. You don't know how efficiently and productively they were. You don't know how many pencils they made. You know nothing about operations other than $20. And so if you really want to manage cash, if you want to make money, you can't live in that in the accounting information. You've got to move upstream. So the way I deal with the situation you just asked me, and Ron Baker and I were just talking about this a couple of weeks ago when we were in my hometown, is that question is almost like asking, well, where's the gas tank on a Tesla? Right? It's an electric car. It doesn't have a gas tank. And so if you're operating in the operations and cash domain to try to figure out the profitability of the unit, you can't do it, because to get there, you have to go through a transformation to get to that cost. And once you do that, you're in the accounting domain. So for you to be able to figure that information out, I mean, the technique that you use, there's another factor here that I think is really critical for people to understand. We go back to that phone example, right, where we pay $25 and it's $25 whether we make no phone calls or an infinite number of local phone calls, right? So to calculate a cost per call, I need a relationship between what I spent and how I used it, right? The number of calls I used, the number of minutes that I consumed, I need some kind of a relationship there. But the problem is there is no relationship. And so if I need a relationship and I don't have one, what do? Well, I make it up. And so the allocation approaches that we use is making up the relationship between independent things. What you pay for that local phone service and how you use it are completely independent. And if we extrapolate that into what happens in a manufacturing environment, what you pay for your materials, you buy 10,000 pounds of steel and you pay for it. It's that price whether you use all of it or you use none. When you pay $30 for an hour of an employee, it's $30 whether they make nothing or an infinite number of parts. When you lease your space, it's that cost whether you use it or not. And so they're completely mathematically independent. And so because they're mathematically independent, to calculate that cost, you have to go through all these gyrations of creating arbitrary relationships, and that calls into question the value of the numbers that you're actually creating on the back end. And so what I try to do with companies in situations like yours is say, all right, so what's your objective here? Is your objective to be profitable or to make money? And they'll come back and say, well, we want to do both. And I say, well, okay, that's fair, but there are going to be situations where, one, making money can compromise being profitable, or flipping it, being profitable can compromise making money. So you got to have a decision that you want to make as an organization. So the companies that you're talking to, the first question is, so do you want to be profitable or do you want to make money? If you want to be profitable, then let's try to figure out a way so that you can focus on generating profit within your organization. And that's not necessarily going to be about cash. So that's going to be about things such as the allocation techniques that you use. For instance, do I want to put my company up for sale? Or do I want to, if it's on the stock market and I want to increase the perception I'm generating cash, then I want a large margin, right? If I want, let's say, a lower tax rate, then I want a smaller margin. So I pick the costing approach that's going to give me the numbers that I want to have on the back end. And then that's how you generally do it. And so when I go to companies and they want me to focus on profitability, then I'll say, okay, so help me understand what you want to do strategically with the organization. And then based on that, let's try to figure out an approach that's going to help you out.
Whew. Oh, thank God this thing is being recorded, because Dr. Lee, it's Friday night, man. It's Friday night. Okay.
All right.
Okay. That was an incredible answer, by the way. And I like to unpack some of that, but let's see if we can bring Andrew in. Andrew, you deal with a lot of IT professionals. I think that's your area of specialty in Toronto. And,
yeah.
And how you doing, by the way? Don't tell me the score of the Toronto game.
Yeah, I'm taping it.
Do you hear the horns out in the background?
No, I don't want to hear it. I don't want to know anything. I'm taping it, so I don't want to know anything.
I'll just tell you there's a lot of hockey going on in this city right now.
So there you go. We've blown it, so okay.
So
when I go to sleep, I can delete the tape and I can go to sleep now.
Sorry about that.
Yeah.
That's fine. You deal with tons of IT professionals, which is all intellectual capital. It's all labor and time. And I'm sure you get this question a lot. How do I know which of my projects are profitable? And for the most part, what they ask you to measure is people's payroll and people's time. How do you deal with that on a day-to-day basis?
I got to be brutally honest. It doesn't actually come up all that often. These guys are, generally speaking, managing their businesses by their bank book, unfortunately. So they're looking, as you said, at cash and cash only, and just saying, okay, is cash continuing to come in the door, and looking at it that way. They're not, and whether that's a good thing or a bad thing, they're not trying to create that connection between their profitability and the number of hours they're spending. They're just looking at, okay, how much money am I putting in my bank? How much am I invoicing? And is that continuing to go up? And they, so for me, I got to admit, it's a bit overwhelming. I'm hearing this. I'm like, it's really interesting, but it's a little deep for me. And I'm like, I have to go back to my cost accounting roots back in school and be like, okay, let's break this down and try to put myself in the place of these people in the manufacturing businesses and having to deal with this cost allocation struggles and figure out, how much of my rent and how much of all this goes into each unit of production. And I'm so used to looking at this myself from a macro level and saying, as you said, it ultimately doesn't really matter. Unfortunately, sometimes we have to put that stuff on a balance sheet and an income statement for the sake of representing it, but it doesn't actually help us manage our businesses any more effectively. And trying to look at other, and I don't know whether they're measures or metrics. I was trying to understand that, but it was a little deep for me. But figuring out whether those measures are metrics and looking at, how many units are we producing per full-time equivalent or per person? How many projects can each of my independent consultants take on and manage? What's the most I can generate for each profit? Can I increase my bill rate for these guys? And what's the value, which is often market driven more than anything else. So to be honest, I'm going to probably do a lot of listening on this episode because it's really interesting, but I'm truthfully in over my head on this topic.
Well, and see, I think that's a key point, because this isn't about trying to figure out all the allocations and such. This is about trying to figure out, if I take on a project, am I making money or not? Not necessarily if I'm profitable or not, but if I'm making money or not. This kind of happened when I worked with a Big Four firm as we were building out our practice. One of the issues was we were hiring some fairly expensive folks, but we weren't getting large projects. One of the early challenges was we wanted to focus on, as we were building out the practice, very well-known names. Well, if we weren't necessarily getting the well-known names, then we had folks on the bench, right? Some very expensive folks. And so the question becomes, so what's the important decision here? Because every month we had to pay the salaries that were going out. And this is money that the firm no longer had. And if we weren't necessarily selling projects to offset the money that we were spending, then from a cash perspective, there's a deficit, which isn't a good thing, right? Now, we can try to figure out what a profitable project looks like. But if we sell one profitable project in a year, and again, that profit is determined by how we choose to cost it, and then you've got other factors such as realization. But let's stick with the costing approach now. right? So if I sell one profitable, there's no guarantee that that's generating enough cash to pay off all the salaries that we had sitting there for a year. And
Well,
so
it doesn't, and sorry to interrupt, but doesn't it come back to just this, are you covering your variable costs? And that whole debate
no, it's bigger than that. It's bigger than that, because when you start thinking about it, you have the office spaces that you have. You've got the accounting organization you've got to pay for. You've got the marketing organization you've got to pay for.
But those are fixed, right? You're going to have those regardless.
Well, so but you still have to pay for them. You still have to pay.
You still have to pay for them.
Right.
If you have an existing business and you can add in a new line or a new service, and by adding variable costs, then as long as you're generating more than your variable costs, yes, there should be an allocation for that. And this is where I think sometimes there's, we run into that debate of, we look at something and say it's not profitable, but if it's an add-on to an existing business and we would have had that office space and we would have had that space sitting there unutilized, isn't it still come back to just covering your variable costs?
No. What that does is, what that tells you, first of all, we've got to make sure that we're consistent with what a fixed and a variable cost is, because accounting has it wrong from a cash perspective. It's backwards. So if you take direct labor, for example,
yeah,
direct labor from an accounting perspective varies with output, right?
Yeah.
But from a cash perspective, if I pay them $30 for that hour, it doesn't change based on how much output they create. The same thing with materials, right? So from an accounting perspective, something that's a variable cost is different than from a cash perspective what a variable cost is. So if we're not precise with what it is we're calling a variable and a fixed cost, and that's going to throw us off. The second thing is, where a lot of firms go wrong is if you're only focused on covering your variable cost, where do you get the information in terms of how much of the fixed cost you need to pay for? And if you don't know what that number is, then you don't know. See, it's not just about covering your variable costs. It's covering your variable costs and being able to kick back enough to cover your fixed costs. So the president of Fidelity Capital had it right. He said what it really is about kicking back to the kitty. And the kicking back to the kitty is all that you've got to understand what the basis of that fixed cost is from a cash perspective. So you know how much cash you need to generate to pay not only for the project or for the new line or whatever it is, but also for all the other costs in the organization. And if you're not factoring that in, there's no guarantee that you're generating enough cash to be able to pay it off.
Right. So I guess a lot of this, as you said, comes down to how clearly you can actually define what your variable costs are and this allocation then of what your
it's not about that at all. In fact, when you use the term allocation, you're quite squarely in the accounting domain. And
okay.
in the accounting domain, you're away from cash. You're not dealing with cash anymore.
I guess the idea is trying to figure out what the actual cost would be if this product or project was running completely independent of itself.
What's the cost tell you? So let's say that you've got a project and we calculate the cost of $100,000. Does that mean we're spending $100,000 in cash to do it? Or would we save $100,000 if we didn't do it?
I guess that depends on the project, and I guess that's what you have to define.
Okay, so let's take a general, any kind of a project, right? So under what circumstances would a project where I'm spending $100,000, would money actually leave the organization? Give me an example.
Let's say just a simple project with a bunch of consultants, and I'm going to hire, a senior guy at $100,000 a year to do some consulting work for me.
Okay.
So $100,000 in labor.
$100,000 leaves the organization, but the people that you hire within the organization, that cost doesn't change, right?
Correct.
If you've got your own employees, that doesn't necessarily change, right? So in that particular situation, what you're looking at is trying to understand, all right, so when I do this project, because let's take a look at a construction project, right? Where what I want to do is maybe cost what that project is. And so I'm going to have maybe subcontracted labor where there's cash out when I pay them. Then I'm going to have my own employees where there's no additional cash out if they work the project, right? But there's going to be a labor cost or labor cost lines associated with both. And so what we need to understand is under what circumstances is money leaving the organization, and in what circumstances money not leaving the organization. If it's my own people, then money's not leaving the organization. And so what that ends up doing is if I don't necessarily understand this effectively, then I'll do things such as, well, I don't want to apply any more of my people's time because the cost is going to go up. Well, the accounting cost is going to go up because you're consuming more of their labor, but the cash cost isn't going to change because you're still paying them their salaries. You see what I'm saying? And so it's
assuming they have capacity to work on the project, and we're sitting there underutilized.
Right. And so in that context, then what we generally don't do is we don't understand the difference between cash and non-cash costs. And because we don't necessarily understand the difference, and then we lump them together, we assume that they're all the same. And so that's why I think it's important, because from a profitability perspective, let's say I've got that $100,000, but let's say I have $200,000 of my own labor force, right? The value of their labor that's consumed is $200,000. I may think that the cost of that project is $300,000, and so therefore I may have to sell it for $400,000. Well, in reality, from a cash perspective, I just pay that one guy $100,000. So anything above, this is your variable cost argument, anything above that $100,000 is going to come back and pay for not only those consultants, but hopefully kick back to the kitty for some of the other costs of the organization. And so what that does, that gives us some flexibility from a pricing perspective, right? Because now I'm thinking, well, if someone offers me, $200,000 for this, I'm going to say, well, no, I'm going to lose money. Well, you're not going to lose money because the only money you're spending is that $100,000 for that guy to come in.
Yeah, and that's what I sort of meant by that variable cost, but I guess I wasn't really explaining it well. But the additional outlay of money, as you're saying, putting it in a cash terms, the additional outlay that you would have to put up to be able to provide that service, as long as you're generating more than that, technically you should be providing that service.
Technically should be providing that service. Yeah, but that still doesn't guarantee. So let's say that for every time we provide that service, we generate $100,000. So we do that 12 times a year. So we've got 1.2 million. But if our overall costs are 1.4 million in cash, we still haven't generated enough, even though with every single project, we've been able to cover the cost of being able to do it.
Right.
Let me, if you don't mind, Andrew, let me use an example as I understand it. That would be sort of the inverse effect. So you're saying we go out and hire a person to do a specific set of projects, and how do we deal with that conundrum of how do we allocate costs and what the real cost is and all that stuff? What if we go the other way? What if we take the advice from most of the experts in the field that tell us fire your unprofitable customers? Right? We hear that all the time, right? People tell us, well, you have to figure out which are your A customers, your B customers, your C customers, and get rid of all the C customers from a profitability perspective, and that's a great move. Now, the challenge with that is that's also making the assumption, as I understand it, Dr. Lee, you jump in any second now, that's making the assumption that you're getting rid of the fat of that customer, but you're also reducing all the fixed costs to stay within this team associated that proportionally reduce the cost, the real cash cost of getting rid of this customer. But the reality is that's not really what happens. Is you get rid of your quote unquote unprofitable customer and you still have all your same fixed costs. So what ends up happening is overall you basically take a cash you take a cash flow problem, right? And most of the smaller bookkeepers, solopreneurs, solo practitioners, they're very adverse to this whole concept of getting rid of unprofitable customers, because they have it right. They say, look, this is going to hurt my profit or my cash flow immediately, and therefore it's just senseless for me to just get rid of my quote unquote unprofitable customers. This is the fallacy of the cost accounting calculations to figure out the profitability per customer. I think what Dr. Lee says is, okay, that may be true. You can get rid of the quote unquote unprofitable customers, but then you have to kick in cost transformation, which is I have a permanent investment into capacity, and I need to be able to turn it into cash in order for me to have a healthy business. And I think part of the problem is accounting and cost accounting only tells you that part of the story. It's the one that's right about who's profitable and who's not, right about what cost center is profitable. And I'll give you another example. Dr. Leon, if you want to chime in on this one, I'll give you another example that's completely different from accounting, which is I used to work for Best Buy, and it was one of the best educations I received ever in my life. And I used to be a department supervisor of the computer department in Long Island City, New York. And when I first got there, the store was horrible at getting rid of what we used to call at-risk inventory, which are things that are obsolete or about to be obsolete. Now, in the books, all these computers have a cost. And whatever I sell this computer for, if I sell it under cost, I get berated for selling the product under cost. But what management is failing to see is that the longer I wait to sell this product, the more obsolete, the less value, and the more of basically a bloodbath I'm going to take on the product later on if I wait too long to sell it. On top of that, it's taking capacity, it's taking shelf space, it's taking capital for me to get new models and new product and stuff that's higher margin, iPads, iPods, whatever they had at the time when I used to work there 16 years ago. But what I used to do, or what I try to do, is I try to get rid of all the crap first, and I used to take a bloodbath on it, and I used to always be dealing with my managers that were looking at these reports that were proving to me that I was losing money. It's like, I'm proving to you, look, the numbers don't lie. We paid $100, you sold it for $80, you're a bad supervisor. And I said, dude, you have to wait, because the way this works is once we get the new product in, the high margin product in, we'll make it up at the end. So the challenge with accounting in my myopic view is that one analysis will render one decision. But if you don't look at the entire business, the entire ecosystem of your decision making, it comes back and bites you. So that's kind of like the way I see it. When I was reading this book, I was remembered that scene in my life where I was fighting with managers about getting rid of this old inventory. And Dr. Lee, I'll ask you, is that right about the lines of what you were trying to say?
Yeah, that's actually correct in both examples, right? So when we start dealing with either profitable or unprofitable customers, products, et cetera, we got to understand what profit represents, right? When I calculate a cost, I propose that the calculated cost is a representation of the value of the resources that you consume. So if Apple's making this pencil, that $20 represents the value of the materials, the labor, machine time, all that stuff that goes into it with some overhead applied to it, right? So there's a value that's there. And so when you start thinking about profitable customers, if I come up with a cost to serve that customer, it just represents the value of the resources that are consumed. So what I argue with companies is it's not necessarily that you're losing money on customers, it's just certain customers consume more of your resources than others. When you put a cost on that consumption, it ends up being a higher cost than the others. So if one consumes 10 hours versus 5, that's going to cost more from an accounting perspective. But the people are there are capacity, so there's nothing that's there from a cash perspective, right? So from a cash perspective, everything's the same. When you get rid of the unprofitable customer, what happens? You lose that cash in if you haven't, like you said, correspondingly reduce your capacity. It happens with customer rationalization, product rationalization. It also happens with make versus buy analyses, right? Because if I'm looking at this Apple Pencil and we say, okay, again, it could be $20 with one approach, it could be $30 with another approach, it could be $15 with another. So we don't really know, right? But we know that if we buy from the outside, it's $25. That's a cash transaction for every pencil that I buy for $25. It's not a cash transaction for when I make one. So now I'm comparing apples and oranges. I'm comparing cash to value. And so with make versus buy, you say, well, you know what? It's cheaper for me to buy from the outside, so I'll just buy it from the outside and maybe I can make something else internally. So your same resources are still there, you're still paying for them, and now you're paying the outside more money to be able to provide you with product. So I see a lot of times when companies actually increase their costs by doing these types of activities. And then when you mentioned your Best Buy work, I ran into that a lot with retail, with not really understanding, especially when you have certain metrics like GMROI, where they're saying, you know what, we've got to make sure that we keep our gross margins that's there, and it's probably driving some of the conversations that you had, right? But the issue is, once I come in with replacement products, I'm never going to get that gross margin. It's just not going to be there, right? Once I have the replacements there, people weren't buying it when we had it, and now we've got 2 or 3 generations beyond that price, we're not going to be able to get it. So either we sell it for what we can sell it for, we write it off, but to assume that we're going to just keep it on the shelf and somehow somebody's going to magically buy it at its full price or something close to full price and we got better products out there is not necessarily a strong business decision. And these are the types of things that, like you said, if we can avoid these by really understanding what's really happening, we've got this, we spent money for this inventory, we've got to figure out how much revenue we can generate by selling it. Let's get as much as we can, but to sit there and hope, like they always say, hope is not a strategy. And in this particular case, it certainly isn't.
And Dr. Lee, under this example, Andrew, you wanted to go?
Just a quick question, because what I hear over and over again is, the word capacity, 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 and capacity seems to play into all of this, right? We talk about, the cliche of people telling us to fire your bad clients, and if you have tons of excess capacity, that's maybe not a great idea. If you don't have a lot of capacity and you've got more clients than you can serve lining up at your door, then firing your worst clients obviously makes sense. So how do you put a cash value on capacity? Or should you, I guess, is the question for Dr. Lee.
Well, let me ask you this. It sounds like there's context behind it. Why are you thinking you need to put a value on capacity? And what type of value are you thinking you need to put on it?
Well, I guess because I hear you talking about trying to measure things by cash. How much cash is going to be going out for this project? How much cash is going to be coming in? And I wonder, so the immeasurable thing that we have, it is potentially measurable, is capacity, right? Mm-hmm. So if you've got a decision whether you should, let's say, add a new line of service, and you're saying, well, I'm going to have to hire this one. If we go back to that project we have with the construction, where you're going to hire one full-time person to do that, but you've got the ability to pull people over from another project, and you're going to pay him $100,000. You're going to generate $200,000 from this, but you've got $50,000 or $75,000 of unused labor right now, and do you put a value on that and say, hey, yeah, I should do this project because I can pull that in, and I'm going to be generating $200,000 of cash and only outlaying $100,000 of cash right now, even though I'm sucking in $75,000 of unused labor. Does that get, I guess, factored in? Do you factor that in at the full rate that it would have been? Do you do some adjustments for the fact that it's underutilized capacity? Do you say, hey, I should give this I should assume that I will always have this capacity and price things like I'll have the capacity? Should you assume that you'll never have the capacity? How do you factor that in when you're making these decisions? Or should you at all?
So I think where you're in what I call mixed domain analysis. And that is, I don't know if you're there or not, but we've got the operations and cash domain and we've got the accounting domain, right? So some of the questions that you were asking kind of straddle both. And so when you straddle both, you're never really going to get a clear answer. It's either one or the other, right? And so when you look at it from a cash perspective, so capacity, I define capacity as what you buy in anticipation of using it. So that's space, that's labor, that's equipment, materials, and technology, okay? So that value that you talked about of capacity and unused capacity, that's an accounting domain question, because now I've got subjectivity. How am I going to figure out the value? For example, another example that I give when I'm giving a talk is, let's say you buy 10 pounds of flour for $10, right? And you're a restaurant. So you use a pound of flour to make bread. So that pound of flour, you say, has a value of $1, right? But then what happens if after I use that 1 pound, I dump the rest of the bag? Is that 1 pound now worth $10? Or what happens if I use 2 pounds and dump the rest? So now the value of that 1 pound can change, right? There's subjectivity. So that's where you start getting into accounting domain stuff. What I know from a cash perspective is that I spent $10, I bought 10 pounds, I used 1, I've got 9 left. So the question is, how can I use that 9 to generate revenue? And so when I start looking at capacity and capacity analyses for companies, it's not necessarily about, during that time it would be, $50,000, $70,000 in unused capacity. Some of the metrics that were used in the analysis, cash analysis, one of the key ones is what's called business cash requirements. And so that takes a look at cash out over time. And that starts generating that whole, this is how much money we're spending and this is how much money we're going to have to offset. So if I've got a project that's coming up and I know that I'm going to be paying these salaries, and the question becomes, all right, so I've got an opportunity to offset these salaries by taking on this project. Do I want to do it or not? If I don't do it, then understand that I still have to pay money for these salaries and nothing's coming in to offset it. So somewhere along the line between now and the end of the year, if I haven't made cash in the earlier part of the year, I'm going to have to generate the cash that I missed by taking this project. You see what I'm saying? So the objective here with the operations and cash domain is to make it very, very clear. This is what you're spending. This is what you're generating. This is what you bought. This is how you use it. This is how this is creating value for the organization in terms of sales. And if I can do all that, if I can see all that, then it becomes really clear. But what happens a lot of times is with many of my clients, customers, sorry, Ron and Ed, with my customers is if I've got someone who's looking at profitability and this is profitable and everything we sold is profitable, and at the end of the year they realize they don't have any money, then what happens is they're looking this way at their accounting analyses, and operations and cash is blindsiding them from this way because they didn't see what was going on. They were looking at a subset of what's really going on with the organization. And so part of what strategic cost transformation is to create a picture of the entire organization so that we can see, all right, you know what? We do have excess capacity here, and we know we're going to have to pay them out at a certain rate. What does the pipeline look like? If we've got a pipeline that's got a lot of stuff there with a high probability of hitting, go with the higher price projects, right? Or the higher value projects. But if I'm sitting there with a pipeline that doesn't look like it's going to hit, and I know that I've got this capacity, then that may suggest, even though from an accounting perspective it's not profitable, it's paying off some of the cash requirements that we have on a regular basis. That's going to put us in a position where for the rest of the year, that's that much less cash we're going to have to generate.
So to break it back to Hector's analogy of firing the bad clients, I guess we want to look at how are we doing along the year? Have we already made enough money to pay our staff? And will we make enough money to pay our staff and cover our costs? If we fire this bad client, then it's a no-brainer, right? And that,
as long as your analysis is complete enough. And so what I see is that a lot of times the analyses are incomplete, and so they don't have a complete picture, right? So if you look at it and say, okay, here's what's happening. We've got one organization that's 50% of our sales, but 75% of our organization is devoted to them. So if we get rid of that company and then we get rid of 75% of our organization, then maybe that kind of makes sense, right? The issue that I run into with companies is they'll do an analysis and say, well, I've got 4 product lines and A, B, and C are profitable. D is not profitable. Let's get rid of it. So now I've lost the revenue coming in without thinking holistically. Well, gee, yeah, those were unprofitable products, let's say, but you were still generating revenue from that business. And so without that revenue coming in and with that cost structure, cash cost structure that Hector mentioned still in place, now I'm in a much, much more negative cash position. And so that's why I propose it's not necessarily an either or, operations and cash or accounting. What I suggest is that accounting information should not be used for managerial purposes. It should be used for reporting purposes, because when you look at accounting information, it comes from operations and cash. It's not creating anything new. So it's not as if that information is not there. It is there. It's just we're not necessarily looking at it in an effective way. If we can look at it in an effective way, we haven't lost any information at all. In fact, we've gained because now it hasn't been converted using the subjectivity and the arbitrary relationships that I mentioned.
So what would be the areas that people most often overlook? Because you said, as long as you've got enough information, what are the areas that most people fall down on?
Number one, not modeling cash. So they assume that profit and cash are the same, and they're not. They assume that costs represent cash, and they don't. And so that's area number one, that there's a misunderstanding of what profit and cash, the relationship between the two. I think number two, there's not necessarily a focus on operations and what's generating the cash and what's causing you to spend the cash. And so what we do is we look at, oh, well, this pencil costs $20. If we can sell it for $100, we make $80. Well, that's not true, because that's not $20 that I spent. And so that margin, I'm focused on that margin. Meanwhile, we miss some of the things that you and I talked about earlier. What's the cost of the organization? How much money do I have to generate to make sure I'm cash positive? Without a holistic perspective, I don't necessarily see that. That's the second one.
Can I throw one in there, Dr. Lee, from basically my day-to-day? Most of the time when business owners are asking me to figure out the true cost, and I'm saying that in quotes, if you're just listening to this, the true cost of my product, which, obviously it's so arbitrary, right? So we talk about the customs cost to bring it in. That's a direct cost. I mean, that's part of the true cost, quote unquote.
Transaction cost.
we have the shipping cost. Then we have, the labor and the storage cost, things that are, maybe a lot more fussy. But at the end of the day, when they start asking me for this, based on how they ask it, I know what the true question is. The true question is how much should I pay my salespeople in commission? And it's so funny that what business owners are not obsessed with the true cost of their product. They really are not. They make it sound like they are, when they come and they ask for these questions, but they're not. What they're really obsessed with is getting great customer experiences, making money on the sales, and paying their employees fairly so they don't lose them. That's really all that it is. So a lot of times we can game the system, and I've been a culprit of that, with knowingly and unknowingly. When the business owner says, "I need you to do a cost analysis using factor A, B, and C," it really is because they're trying to pay less commission to their salespeople or justify changing or transforming the commission structure. So I think that's one of the things that I wanted to throw in there is using arbitrary measurements as an excuse or support to make a decision that is just wrong, period. Or it's really a forced decision. Like they knew what they wanted to arrive to, therefore they used whatever allocation they wanted to force that in there. And that shapes the entire behavior of the business. So, understand what do they miss? Well, what they do miss is that they use the rock and foundation of accounting measurements to justify really dumb decisions that just sends the business down the toilet. So I wanted to throw that in there. I don't know if that's relevant.
Yeah, I think that's very relevant. And I think looks like I'm frozen. I apologize for that. I'm not sure what happened.
We can still hear you.
We can hear you.
Okay. And I apologize, and I'll try to work to get back on this. But and so I think that's very relevant, and I think that's very relevant for a number of reasons. Number one, when you start thinking about contribution margins, and let's see, all right. So when you start thinking about contribution margins, right, the general approach with contribution margins is to try to figure out, all right, so what are my variable costs and sales minus variable costs, right? Kind of like Andrew was talking about before. But fixed and variable costs are different from a cash perspective, so that doesn't necessarily tell you it, right? So when you're talking about let's say the margins that you're making, and you're going to pay a commission based on the margins that you're making, let's say, right? So here's an example that I like to give. Let's say that you're a company that offers software as a service, and you offer, let's say, storage, right? So if you offer storage, and let's say you come up with a cost of storage, you can say, all right, so if it costs me, I calculate it costs me $50 to provide a terabyte of data, and so I sell it for $100. I quote unquote make 50, which we know that you don't, but that's okay. Let's say we make 50. But what if, to provide you with that storage, I now have to go out and buy a server, and that server costs me $3,000? How does that factor into the commission, right? So if I don't look at, this is to Andrew's point, if I don't look at this thing holistically and say, for me to be able to get this business, what money do I have to spend? Then if the salesman says, hey, you know what, I just sold this project, we're going to make money, and you go back and say, not really, because for us to be able to deliver this project, we have to spend more money, and it's going to take us years to be able to recover that. And so therefore, the answer is probably we shouldn't sell it. So if I don't look at this thing holistically, I'm not going to be able to model it effectively so that I can make those decisions that you're talking about.
That's a great point. And Dr. Lee, we're an hour in, and I want to be mindful of your time and also try to stay within this 1 hour artificial limit metric that we built ourselves for this podcast. But I wanted to kind of take it home and maybe tell you a little bit about some of my favorite learnings from your book. Chapter 14 and chapter 15 are my two favorites that talk about the process of doing business cash modeling and metrics versus measurements. Mm-hmm. And in there, you basically give us a tool that is, I don't want to call it an alternative to financial statements, but it's something that we can use in conjunction with financial statements, which is building what you call the BCR, the business cash requirements. So do you want me to summarize it, or would you like to?
Yeah, the BCR is just what we were talking about before. And so when you look at, if you put a box around a company and look at the money that leaves that company, that's cash out. And so the BCR represents how much money we're spending. So on a periodic basis, I can project things like labor cost, space costs. I can figure out all these things based on understanding the timing of when they're supposed to go out. And so that gives me a way to be able to, oh, looks like we're back. It gives me a way to be able to start understanding how to project cash. So let's say, for instance, you got a situation where you've got to do overtime. You don't necessarily know the impact of overtime unless you look at, on your next payroll cycle, unless you look at the cash requirements. How many hours are we going to run? Who's going to run them? What are their hourly rates? So I know that on the 15th of the month, when the next payroll cycle hits, this is how much money I'm going to have to pay in cash. Most of the time, we don't necessarily know that. The other thing is, like we talked about earlier, if I don't know how much money I'm spending on a regular basis and the cumulative effect of that, I don't know how much money I have to generate to make sure I am cash positive at the end of the year. And that's another thing, Andrew, that people are missing, is that they don't look at this thing holistically to be able to understand how much cash am I spending. I have so many clients where they say everything I'm selling is profitable, but I don't have any money. And it's because they're not looking at the right things, right? And so BCR allows you to understand how much money is going out, why is it going out? Because, we can go back to the cash flow statements and say, well, can't you get the same information from cash flow statements? And the answer is no, because you can't look at a cash flow statement, let's say a labor line on the cash flow statement, and determine what were the people paid, how many hours did they work, why did they work those hours, was there overtime built in or not, how much overtime? We have no context for it at all. And so BCR gives you that context for understanding what it is I'm doing, what cash effect is it going to have, and then to be able to plan accordingly. So I think it's a really powerful tool to help people understand, we're spending at this rate. Are we generating cash at a rate to offset it? And if not, then we need to start thinking about things such as reducing our BCR or increasing the amount of cash that we're bringing in to offset the BCR.
And in the BCR, something worth mentioning is basically you're gonna break down. Imagine if you were doing a profit and loss and taking all your expenditures, and obviously take cost of goods sold out of the equation completely when it comes to inventory anyway. But the direct project costs, of course, those are part of your cash costs. But you break down your costs into three buckets. One is taxes, fees, and royalties, which I see as uncontrollables. These are the things that we have to pay: regulation, contractual agreements, things that you just have to pay. You can't, and some of these are variable and some of these are fixed. I mean, they could be various of them. Then the second bucket is transactions, and these are all of the sort of operating admin expenses that you make based on decisions you made with your business, such as paying loans of money that you borrowed, paying to fix something in the office, something just sort of casual, not something planned. And the third and the biggest bucket is capacity. And what I love about this is the context of this is when you think about running your business, every expenditure you make that's not a tax fee and royalty or a transaction is investment into your capacity. Mm-hmm. And I think that in your mind, if you look at your rent and your equipment, and I would say the cost of the equipment that you use for your jobs, right, and your employees, that's all investment into capacity. And the purpose of running a business is transforming your investment of capacity into cash. That's it. That's all it is. And I think that in accrual financial statements, we lose all that because we're just looking at the historical performance of a business based on a reporting system really designed for people to make financial investment decisions, not operating decisions, which is what you call the business domain management. So I love, like, this is the one thing that I said, look, I could take this to a customer and do this immediately because all I have to do is figure out which of the expenditures fit in this category and just do a historical analysis. But then when I'm consulting with my clients is to say, okay, let me help you make the decision, whatever it is, expanding, contracting, adding a new employee, whatever it happens to be. So if we take this historical information of your financial statements, transform into these three buckets. And then we can project these out to 6 months, 10 months, 12 months, whatever. Now I know exactly how much cash I need to generate to keep my head afloat. And then based on that, that's the number I need to figure out how many projects I need to take in, how many clients, how much sales, and how to price my services. So it just completely transforms the way you look at traditional cost plus pricing where, hey, my employee cost me $25 an hour. Ergo, if I charge $75 per hour for this employee, I'm profitable. And that's just wrong. It's a fallacy. So when you look at it in terms of transforming your cash outlay of capacity into cash inputs, that's really, I think that's what I got from this. This is the transformation process. And great business operators, not even a CEO, this is more like COO type of level, right? It's operators, the ones that decide, turn this machine on, send this guy home, approve this overtime. The people that are in the trenches making these decisions every day, they don't have these tools at their disposal. They may have some report from QuickBooks that tells them nothing about what they need to do, and they're making gut feeling decisions all day long. So as accountants, we can step into this role where we can give these people the tools, maybe by using some of the stuff in your book, maybe your next book that's coming out, I think you're coming out with a book that's really going to be more tool driven. And that's what I take from this. And this is why I recommend people read this book, because it will change the way you look at the real usefulness of financial statements, not as an accountant, but as a business advisor,
I think that's a great summary, because, when I hear companies, let's say that you've got, an automated 5-axis CNC machine versus, a milling machine, right? And someone will say, well, it's too expensive to run this job on the 5-axis. We got to do manual. And you're just sitting there thinking, it's sitting there. Nobody's using it. It's not going to cost you any more cash to use it. But people will say, well, I can't do it that way. I got to do it over here. I got to make it in this department. And when you understand that, from a cash perspective, it makes no difference. Now you can say, let's just run it on the machine and let's go.
And I'll make a confession. I'm a culprit of this problem, right? Because I have 3 levels of technicians in my office. I have me, who I'm self-proclaimed the most expensive one in the office. Then I have 2 senior folks that are sort of like almost as expensive I am, 20% less. And then some of those folks that just do the data entry, line level stuff. And then some jobs come in that where the client, we just didn't price it, let's say at the hectare level. And I would just completely refuse to touch it, talk to the client, because the cost of me doing it is just way too high. And sometimes I fail to think that when I'm just sitting there relaxing, kicking tires, I could be doing these jobs and open capacity for my other employees to do other things. But there might be some other factors playing into that role, more psychological and more about how I think about myself and how partners think about themselves in accounting practices. But I think we run into the situations all the time as well.
Yeah, you do. And I think that, this is where it becomes important to decide, is it about cash or is it about profit? Because if you want to determine the profit of the job, then of course putting your time on it is not necessarily going to be a good thing. So for reporting purposes, if you're reporting based on the job, that may not necessarily be a good thing. But if you're sitting there thinking, all right, I'm going to lose money if I spend time on it, the answer is you're not going to lose money. You may lose profit, but you won't necessarily lose money. And it's important to understand the difference between the two. And I think that, to me, is the power of strategic cost transformation, is that it helps people understand there are differences. And here's why there are differences. And you need to see the whole picture so that you can manage the organization more effectively. And if you're only looking at one side of the picture, then you're going to miss out. Even, for example, even if I only focus on the operations and cash domain, I'm not going to understand what it is I'm reporting. And so therefore, if I'm trying to lower my effective tax rate, or if I'm trying to put myself in a position to sell and I want to hire multiple, I may do things from a cash perspective that jeopardize that. So it's really a combination of bringing both sets of data together so I can have a complete picture of what's happening within the business. And now I understand the trade-offs. But if I'm only looking at one and not the other, I don't understand the trade-offs, and there's a risk there.
Dr. Lee, I could talk about this forever. I got to tell you, you're a great guest, and
Thank you.
I think we're becoming great virtual friends via Facebook and LinkedIn. So that's obviously very pleasant. Andrew, do you want to add any last words or any last questions?
Well, first of all, I want to thank Dr. Lee for joining us and apologize for talking about the honking horns and ruining the recorded game for you, as well as apologize for my ignorance on the subject and not being as knowledgeable as the two of you. But it really has been eye-opening for me, and I think, Hector, you put it really well. That sort of a big eye-opening thing for me is when you said, as business owners, we invest in capacity with the hope of making money off of it. And I think that's such a really eloquent way of putting things. And it's not one that I've sort of thought of, but that's what we do, right? We invest in capacity, whether that's people, a building, technology, processes, whatever it is. We're investing in capacity with the hope of being able to generate cash with that capacity down the road. And I think that's the big takeaway for me, as well as the number two takeaway is I got to go read Reggie's books and get schooled and better understand this concept. And it sounds really interesting, this alternative to the cash flow statement that brings in these three ideas. So you'll put the link up, I'm sure, right, Hector, into the
link is up. Yeah, the link is up on Facebook.
Yeah, I think the best place to buy the books, if you guys want, go to my website because I've got probably the best prices for them, and I've got inventory of them. Amazon is really kind of strange. They've been, there have been times when they've quoted 6-8 week lead times. It's kind of crazy. So either my site or I sell them for 25. I think Amazon's 36, and I think the publisher is 35. So either Business Expert Press, which is the publisher, or come to my site at bdrco.org. And
repeat that. What is it?
So my company is Business Dynamics and Research. So it's B as in boy, D as in David, RCO.org. And then if you go to the shopping link, there should be a shopping link. Then I sell the books there for $25. That includes shipping.
I'll put the link up. I'll put the link up in Facebook.
Right.
Okay. And Dr. Lee, you're working on another book. There's another book coming.
I am. It's a little bit different than what you had suggested. This is kind of an interesting book when you start thinking about companies that make investment decisions. So whether it's IT, whether it's Lean Six Sigma, the question is, you want the project to be profitable, but the question is, what's profitability mean? So if we're talking about accounting profitability, then you have situations where, I'll give you an example. One of my clients, and if the folks have heard me speak, they've heard this before, but this guy named Gary, and the software guy came to Gary and said, hey, if you buy our software, we'll save you $4 million. And Gary said, how? Better information, faster information. He said, I get it, but how? People are more productive. And Gary said, listen, here's the issue. You're saying I'm going to save $4 million. That to me now means I'm going to spend $4 million fewer dollars as a result of buying your software. Help me understand how I'm going to spend $4 million fewer dollars. And if you can't do that, then I'm not going to buy your value proposition. And they couldn't. And he said, okay, I'll buy the software because it's good for the business, but I don't want to be on the hook for $4 million that I know is not going to be there from a cash perspective. So project profitability is about helping people understand how to use these tools to understand where the real true cash and non-cash costs are, so that they don't deal with situations where they've got these inflated value propositions. We'll save you $75 million if you buy our software. Well, how does that $75 million calculate? I'm going to make everybody in the organization 20% more efficient. Well, that's non-cash cost. And so now I've got this huge non-cash cost savings. And I'm saying, so if I can save you $75 million, of course you're going to spend $20 million on the software, right? It's a great deal for you. Yeah. And then spend the $20 million, and guess what? The 75 never comes because they still have that capacity that's there that they're paying for. And so project profitability lays out how to scope projects, how to identify what the capacity impact of projects is, how to determine what the cash and non-cash cost impact is, and then once you execute them, things to look for in the back end to ensure that you're going to get the cash savings and the non-cash savings as identified in your value proposition.
All right, so when that book comes out and we want to get another Dr. Lee headache, we'll invite you back. And thank you very much, Andrew. Have a good night. Dr. Lee, it was an honor. Thank you very much.
This is so cool. Thank you.
Bye.
Thanks, guys. Have a good night.